Imagine planting a single seed today and watching it grow into a massive tree over time, providing fruit year after year without you doing anything extra. That's exactly how compound interest works in the world of money. It's often called the most powerful force in finance, and once you understand it, you can make your money work for you while you sleep. At its core, compound interest is the process where not only your original investment earns interest, but the interest itself also earns interest over time, creating a snowball effect that grows faster and faster as the years go by. For example, if you invest $1,000 at a 10% annual interest rate, after the first year, you earn $100, making your total $1,100. But in the second year, that $1,100 earns 10%, giving you $110 instead of just $100. And this cycle continues year after year. This may seem small at first, but the real magic happens when you let time do its work. The longer you leave your money invested, the faster it grows, because each year you're earning interest not just on your initial investment, but also on all the interest accumulated from previous years. This is why experts always emphasize starting early. Even small amounts invested today can turn into a huge sum decades later, all thanks to the exponential growth effect of compound interest. Unlike simple interest, where you earn a fixed percentage only on the principal, compound interest accelerates your wealth in a way that can feel almost like magic, rewarding patience and consistency. But the real question is, how do you make this magic work for you? And what factors determine just how fast your money can grow? To fully harness the power of compound interest, you need to understand the three main factors that determine how quickly your money grows: the principal, the interest rate, and the time your money is invested. The principal is simply the initial amount you invest or save, and it forms the foundation of your wealth-building journey. Even a small principal, if invested consistently over time, can grow into a surprisingly large amount due to compounding. Next is the interest rate, which acts like the engine of your money's growth. A higher interest rate accelerates the compounding process, while a lower rate slows it down. But even modest rates can produce amazing results over long periods. Finally, and perhaps most importantly, is time. Time is the secret weapon in the compound interest formula, because compounding works exponentially. The longer your money remains invested, the more dramatic the growth becomes. This is why financial experts often say that the best time to start investing was yesterday, and the second best time is today. For instance, investing $1,000 at 10% annually for 10 years gives you around $2,593, but leaving that same money untouched for 30 years grows it to more than $17,000, purely because of the effect of compounding. This exponential growth isn't linear. It starts slow, but then accelerates dramatically as the interest keeps building on itself. Understanding this principle can completely change how you view saving and investing, turning what seems like a small, manageable habit today into significant financial freedom decades later. But beyond theory, the real power of compound interest shines when combined with regular contributions, reinvested earnings, and patience, making it not just a concept, but a practical strategy for long-term wealth creation.
Now that we understand how compound interest works and the factors that drive it, let's look at real-life strategies to maximize its benefits and truly make your money grow. One of the most effective ways is to start as early as possible. Time is your biggest ally. Even small, consistent contributions made every month or year can add up to enormous amounts over decades. For example, if you invest just $200 per month at an average annual return of 8%, in 30 years, you would accumulate over $280,000 while contributing only $72,000 of your own money. The rest comes from the magic of compounding. Another powerful strategy is to reinvest all your earnings, whether it's interest from a savings account, dividends from stocks, or profits from bonds. Keeping that money in the investment allows it to generate more returns, accelerating growth. Avoid withdrawing early, because taking out money stops the compounding process and significantly reduces the final amount you could accumulate. Diversifying your investments is also key. Different asset classes like stocks, mutual funds, and ETFs compound differently, and balancing them according to your risk tolerance ensures steady growth while protecting your principal. Furthermore, patience and consistency are more important than chasing high returns in the short term. Compound interest rewards the long-term mindset. Investors who resist the urge to make impulsive withdrawals or frequent changes to their strategy tend tend to see the most dramatic results. Finally, understanding the tax implications and fees associated with your investments can help you keep more of your compounding gains, because every dollar lost to unnecessary fees or taxes is a dollar that isn't compounding. By combining early investment, regular contributions, reinvested earnings, diversification, and patience, you can turn compound interest into a powerful engine that steadily builds wealth over time, proving why it's called one of the most powerful forces in finance, and why those who understand it have a massive advantage in achieving financial freedom.
So what does all of this mean for you and your financial future? The lesson is simple but powerful. Start now, be consistent, and let time and patience do the heavy lifting. Compound interest isn't just a concept, it's a strategy that can turn even modest savings into life-changing wealth if you apply it wisely. The key actionable steps are: first, begin investing as early as possible, even if the amount seems small. Second, commit to regular contributions, no matter how little, because consistency compounds over time. Third, always reinvest your earnings to maximize growth and never interrupt the compounding cycle unless absolutely necessary. Fourth, choose investments wisely and diversify to balance growth with safety. And finally, educate yourself about fees, taxes, and other factors that can silently eat into your compounding gains. Remember, every day you delay is a missed opportunity for your money to grow, and every dollar invested today can grow exponentially in the years ahead. By embracing compound interest, you are not just saving, you are building a financial engine that works for you tirelessly, creating the freedom to live life on your terms. So start today, stay disciplined, and watch your money grow faster than you ever imagined, because the true power of compound interest isn't just in numbers, it's in the time you give it and the patience you maintain. The earlier you start, the more extraordinary your financial journey will be.
To take your understanding of compound interest even further, let's explore some practical real-life scenarios and tips that can make a massive difference. Consider this. Two people invest the same amount of money, but one starts at age 25, while the other waits until age 35. Even if the second person invests larger amounts, the first person almost always ends up with more money in the long run, simply because their money had more time to compound. This shows that in the world of investing, time often beats money. Another tip is to automate your savings and investments. Setting up automatic transfers to a retirement account, mutual fund, or stock portfolio ensures that you never miss a contribution, and it takes advantage of dollar cost averaging, which smooths out market ups and downs while compounding works behind the scenes. You should also pay attention to the power of interest on interest. For instance, if your investment grows 8% per year, in the first year, your $1,000 earns $80, but by the 20th year, that same 8% could be earning hundreds or even thousands each year, purely because you're earning interest on all the accumulated interest. This exponential growth is what turns small, disciplined steps into financial milestones that feel almost magical. And finally, mindset matters. People who focus on long-term growth rather than instant gratification are the ones who truly harness the power of compounding. Avoid the temptation to withdraw early, chase risky get-rich-quick schemes, or panic during market fluctuations. With patience, consistency, and smart choices, compound interest can become your personal wealth-building engine. So take control today. Start small, start early, and let the power of compounding transform your financial future into one of freedom, security, and opportunity that grows faster than you ever imagined. Let's go one step further and talk about advanced strategies and common mistakes when it comes to compound interest, because knowing these can make the difference between average growth and extraordinary wealth. One advanced strategy is to take advantage of higher compounding frequency. For example, some accounts or investments compound monthly or even daily rather than yearly. The more frequently your interest compounds, the faster your money grows, even if the interest rate stays the same. Another strategy is to use tax-advantaged accounts like retirement plans or certain investment accounts that shield your earnings from taxes, because taxes reduce the amount of money that gets to compound. On the flip side, common mistakes can severely limit the power of compounding. Waiting too long to start, withdrawing earnings too often, not reinvesting dividends, ignoring fees, or chasing high-risk investments without understanding them can all slow or even reverse the growth of your money. A real-world example: someone who invests $5,000 per year at 7% from age 25 to 65 could retire with over $1 million. But delaying even 5 years could reduce the final amount by hundreds of thousands of dollars. Finally, remember that compound interest isn't just for retirement. It can work for any long-term financial goal, whether it's buying a house, funding education, or building an emergency fund. The secret is discipline, consistency, and time. The sooner you start, the more powerful compounding becomes, and the more financial freedom you create for yourself. By avoiding common mistakes, maximizing compounding opportunities, and staying patient, you can turn your small daily financial habits into a future of wealth and security that keeps growing long after you've stopped actively working for it.